All right, everybody. We are going to get started today with the webinar. Thanks for coming. This is a webinar. This is a brand new topic for me, by the way. I've been formulating this topic that we're calling the 4 stages of IBC commitment. I've been formulating this idea for a long time, or at least I think I have. I've been trying to figure out how to convey what I'm trying to convey today in a way that makes sense to IBCers, because there's so many questions about IBC that I think if you understand what I'm about to go through today, it'll be very helpful to you. I really do. So I think, honestly, this might not even be that good. It's the first time I've ever done this as far as this discussion. And I plan on fine tuning it more and more and more. I think I'm on to something that I think will be very beneficial to the IBC community on understanding where you are at with IBC. And then because of where you're at, what you should be doing to get the most out of IBC based on where you're at and based on how you've committed to it. So I think this is going to be extremely important. I think it's going to be extremely beneficial to understand. And I am hoping to get this in and out in an hour. That's my goal. So we're going to dive in. I'm going to talk fast like I normally do. We're going to go through a lot of things as we going today. So I guess some of the agenda is going to be, I wanted to discuss what are the 4 stages of IBC. That's how we're going to get started today. We're going to discuss what are the 4 stages, what are the hallmarks of each stage, what are the things you should be doing in each stage. And then I wanted to go transition into an actual example, a hypothetical situation. It's actually kind of based on me, by the way, not exactly, but just rounded and easy to understand. Hypothetical example of someone who's going to get started into IBC and what it would look like for that person with their income, their expenses, their investments, and all sorts of things. What would it look like to get started, to enter into each stage? Now, I would also just give a warning that some of you are going to wish I was more detailed in that scenario. I would tell you I tried to be, but it got so convoluted that I was starting to say, well, it's going to take me 2 hours to get through this. So I might do another webinar with more complexity that picks up where this one didn't enter into. So just understand that. But all that to say, I think it's going to go very well today. We're going to dive in. So I'm going to discuss what are the 4 stages. By the way, the first 15 to 20 minutes when I'm doing this is actually the meat. The examples that we're going to get into are just kind of showing and revealing and helping solidify the things. But I really believe if you understand this, what I'm about to say, IBC might make more sense, especially how you may want to use IBC and where you're at. It may help you realize why things haven't made a ton of sense to you yet. Especially for those of you who are already doing IBC and are kind of wondering why you don't find yourself using your policy very often. I think this can really help answer this question better than anything I've come up with thus far. And I've tried to tell people this. So let's go ahead and dive in. I believe the premise of all of this is that I believe everyone can benefit in some way from practicing the infinite banking concept. That's a belief of mine. I believe at the very lowest level, there's some objectivity to that, where it is unlikely, if we look at a standard bell curve of people, it's unless you're on far either sides of these people, I think it's likely that IBC will benefit you in some way. As I've said to many of you, maybe even on this call, many of you, I've said it many times to clients that the question is typically not, can practicing IBC benefit me? Can doing this infinite banking thing benefit me? Oftentimes, the question really is, well, at what scale should I be committing to IBC at based on where I'm at this time? And so I really believe that there is a level of commitment that can exist in IBC, that there's kind of 4 stages that I've been thinking about, that these 4 stages seem to fit almost everyone I know, that they fall into one of these 4 stages. And essentially the question is, which stage am I in? Does it make sense for me to stay in this stage? What do I have to do to get to a different stage? Will I enjoy being in another stage? Essentially what I'm trying to get is everyone can benefit from IBC. The question really is, at what scale should you be committing to? What scale should you be practicing IBC at? And so inside, and by the way, we just did a podcast this week. For those of you on the live webinar, we just did a podcast this week where we talked about, just launched on Monday, the 4 stages of IBC, actually probably in more detail than I'm going to be able to do quickly, because I've got more to do in this webinar than I do just describing the 4 stages of IBC. So if you haven't listened to that podcast, I'd recommend you go listen to it as well, just to refresh and revisit what I'm about to go through here. So essentially there's 4 stages. To premise all of this as well, the IBC can get confusing and I'm going to talk a lot about this. IBC can get confusing when your mind is thinking that and is committed to and is excited about maybe a stage 3 or stage 4, entrepreneur lifestyle stage ideas. So when you think in your mind, you're thinking of these, later 2 stages, the entrepreneur lifestyle stages, as being the stages that IBC is being committed at. However, by what you're doing, you're actually only maybe in stage 1 or stage 2. And what you find is people get extremely confused as to why some of the things that they hear being talked about that IBCers are doing, why it doesn't seem to make sense for them to do those things at the time. And once again, I think it's all based on the IBC commitment. So essentially, let's go ahead and dive in. I'm to start off with, I'm gonna go through each stage, kind of what are the hallmarks of each stage of IBC commitment. What are the hallmarks of it? And so we're going to start with the saver here to begin with. So the saver stage is kind of the lowest, it's the entry level stage for most people. It's also what I refer to as the objective stage. And what I mean by the objective stage is that I really have a hard time coming up with an individual where the saver stage doesn't make sense to start practicing it. So the saver stage is what I kind of call the objective stage, because I believe that pretty much everybody is going to, or at least it's a desire for them to have some liquid money available to them to weather financial storms. So whether you're listening to Dave Ramsey, Susie Orman, or just living life, a lot of times you want to have some money set aside for an emergency fund. You want to have some money set aside for different things, and you want it to be liquid. So in the saver stage, you are essentially, it's the simplest one. All you're going to do is start to transition some of the basic saving situation that you're in into a policy. And that's all you're going to do. So in the saver stage, some of the hallmarks of this stage, oftentimes what we'll be doing is we're going to move the emergency fund into policies, right? So this is setting the stage. So a lot of times, let's say you have $30,000, $40,000 in an emergency fund. If you're committing to the saver stage, a lot of times the hallmarks of this stage is that it's going to be kind of a small scale. It's a good place to put money. It's a good place to move my emergency fund into. It's going to do better than the bank is going to do for me, but that's essentially what you're committing to. And so in this stage, we're going to have, you'll put in, maybe you'll transition over time your emergency fund money, like the liquid cash that's already sitting around, and you're just saying, hey, the bank's not giving me anything for it. I'd rather move it slowly into a policy over time. This could be some people in the saver stage also, you'll technically start, maybe you'll think of in terms of diversify. You say, well, I've already got some money in retirement programs, already got some money here. I'll go ahead and diversify a little bit. I'll diversify a little bit. I'll put a little bit of money here into this policy. I'll start saving some money. I'll start diversifying that, but it's not going to be a very big piece overall. It's mainly going to be money that oftentimes that's in the bank anyway, or that will be in the bank anyway. So in the saver stage, you're really not going to change much about your life. The hallmark of this stage, to kind of focus on, the hallmark of this stage is that you will rarely use the policy. You are going to rarely use the policy in this stage. And the reason you're going to rarely use the policy is because mainly to you are moving money into IBC, into this policy, as just a safe place that's better than the bank to store some money. So in reality, there's some people who, and this is also the lowest level of commitment, for you. Now, remember, your premium amounts the actual dollar of premium doesn't matter. The proportion of premium compared to your financial position is what we're really talking about here. So obviously, a guy who's making $1 million a year, his saver stage might be pretty big. You might have a pretty big saver stage. Your premium levels might be really high compared to the guy who's making $100,000 a year. His savers, in other words, the $1 million guy's saver stage is going to be bigger than the $100,000 guy's lifestyle stage. So the actual premium dollars do not matter at all. It is actually kind of how much are we committing to of our overall financial ability. The saver stage is oftentimes the lowest hanging fruit. It's the liquid money, the little bit of savings in here. It's the people who are going to diversify. And if you are in this stage, you are rarely going to use the policy in this stage by design. It's a smaller piece of your life. On top of that, especially, so note this too, especially in this stage, not only are you going to rarely use it, but there is no intentionality. There is no intentionality. In other words, it's not exactly just that you're not going to use it per se. It's also that whenever you started the policy, there was not an intention to use it. It's not like you came into it thinking I'm going to use this policy for something. The problem that I find is that some people in the saver stage think that they ought to be doing things that we're going to run into in these future stages. The problem is that's when it gets all wonky and weird. When people start borrowing from policies to do things in the saver stage, a lot of times it doesn't even make any sense. In other words, a lot of times we're just going to be borrowing money to pay interest to the life insurance company on a policy loan without receiving any additional benefit, essentially, in this stage. So this is where some people think that they are committing to a high level. And I've got so much more to say, but just for the sake of time, I don't think I should. But essentially, in the saver stage, it's oftentimes it's also what I call the objective stage. And by that, I mean, really, I don't think of a reason why someone wouldn't want to do that. And we're going to talk about that in the examples as well. I'm going to show you what I mean by that. So it's kind of the objective stage. Everybody should be doing this. There's really no question. The pro is that you're going to be making a lot more money even in the saver stage than you would have just leaving money in bank accounts and so forth. However, the con is that you really are not going to accomplish much, and you're probably going to leave a lot of money on the table that you could have had if you had just gotten a little bit more committed to it. So that's the saver stage. The capital builder stage is what we call the next stage. And I invented these terms. Sorry if they're not too original. But the capital builder stage is essentially everything that would have taken place in the saver stage. These are essentially every time we advance to a new stage, it's assuming that you're also doing the stage before it, right? It's assuming now you don't have to go in order. You don't have to start it as the saver and then go to the capital builder and then go to the entrepreneur and then go to the lifestyle. You don't have to do it in order. You can start as an entrepreneur if you wanted to, but I am saying that it's going to assume that all of these things are taking place. So in the capital builder stage, the kind of the hallmark of this second stage is that you are going to start to redirect other cash flow into your policies. So you're not just moving your emergency fund in, you're not just diversifying and putting a little money over there to let it sit because you just feel like it's a nice, safe place. It's whenever you're redirecting some cash flow that used to go other places into the policy. So we are going to move the emergency fund in, we are going to put some money in just from the saver stage, but we're also committing to redirect other cash flow. Maybe it's oftentimes in this stage as well, you will likely be using the policy. But I would also like to mention in this stage, oftentimes you're using the policy for personal reasons a lot of the times. So inside of this policy, you actually have another thing, you have intentionality. So in this stage, the biggest difference between stage 1 and stage 2, so this is 1, this is 2, 3, 4 for easy reference. And the biggest difference between stage 1 and stage 2 is that in the capital builder stage, oftentimes someone is starting to bring forth intentionality. That's actually the biggest difference, I would say. Intentionality, which means I want to accomplish things. I even am thinking about the things I want to accomplish. And so I'm redirecting capital to the policy in order to accomplish those things. So the capital builder stage, the main hallmark, I guess I should use my hallmark asterisk thing, is that in this stage, the intentionality has been included. Now it's not just I'm going to set aside some emergency fund because it's a better place to put money. It's not just I'm going to diversify into a policy because it's better than because I want the 4 to 5% growth, tax-free, safe, and I've got enough elsewhere. Those are the saver environment. You're rarely going to use it, and there's no intentionality. You didn't start the policy with any sort of intention to use the policy. You may think in your mind, I'm doing IBC, so I will probably use the policy, but there wasn't anything truly on your mind in the saver stage. It's very common. So the capital builder stage, essentially, you're committing to producing higher premiums. Your more money is going into to capitalized policies than the saver stage, and there's reasons for it. There's intentions for it. In this stage, some of the hallmarks of practicing IBC in the capital builder stage, oftentimes you'll see things like these are the kind of people who will finance home remodels with policies. Like they'll think about doing that. They'll buy their cars. They will, spend. They'll send their kids to school for college education. Maybe they'll redirect 529s because they want to use it for policy. The 529 money for policy money to then send their kids to school from that. But it's kind of, and occasionally there will be some leftover money as well to start making investments from the policy. Maybe we weren't intentionally thinking about that at the time, but essentially in the capital builder stage is when we start to redirect cash flow that used to go to other things. Oh, and one more thing, certainly is pay down debt. That's also very common. So if someone has any sort of debt, that's oftentimes, the capital builder will start redirecting cash flow into policies, and they'll use it to pay down debt. Now, obviously, depending on whether you should do that, that's not the goal of this webinar, as far as what debts you should take over and whatnot. But essentially, in the capital builder stage, there is a higher commitment to increase the cash flow going into premium. You're going to be using the policies with intentionality, that whenever you started, you actually had some idea of what you were going to do with it. You actually had some thoughts. Now, that's not exactly required, but essentially what it's assumed. In other words, you're putting so much premium in this stage that you know that it's going to be likely that you're going to use the policies. That's essentially what we mean. You may not have had a pure intentionality, but you're like, I am going to redirect some of this additional cash flow because I want to be able to use it for the things that come down the way. And I know there's going to be things I'm going to need it for. The saver is not even really thinking that. He's thinking of it as a savings account and as an emergency fund replacement, and a little bit of a diversification replacement. Now, that's why I'm trying to say, if that's all you've done, then it's hard. Then whenever you hear us talking about buying cars and, remodeling houses and going on vacation and paying down debt, making investments, and you are actually in the saver stage, the reality is it can get wonky because you're always confused why you would use the policy to do things that you already have the money to do elsewhere. That's the issue with the saver stage. Using the policy is rare. And the reason it's rare is because it doesn't always even make sense to use the policy, because the policy, you haven't committed to a high enough level to be able to use it for the things you want to use it for. So that's the capital builder stage. The hallmarks of this is that we have added intentionality to it. We're going to be using the policy. We've redirected more money to go in. Maybe it's money that we had been putting into 529s, 401ks, IRAs, savings elsewhere, and so forth. But we are committing to a higher level. The entrepreneurs, and I'm going fast, so because we have a lot to cover. The entrepreneur stage is the next stage. The hallmark of this stage, by the way, the reason it's called the entrepreneur stage is not because you have to be an entrepreneur before you do this stage. The reason it's called the entrepreneur stage is because in this stage, you will essentially be running your commitment level is like, I want to be in the banking business. You're going to run your IBC system like a business in the entrepreneur stage. That is the hallmark of the entrepreneur stage, is that we're going to run this like a banking business. So in the entrepreneur stage, what separates stage 2 to stage 3 is that in this stage, every dollar of free cash flow is going to policies. Now, what do I mean by free cash flow? Essentially, every dollar that's not being spent on just regular lifestyle expenses, or just I would just say expenses. Every dollar that is above expenses that you make. So you live on less than you make. You're saving money. Every dollar of free cash flow is going to policy. In this stage, in the entrepreneur stage, you are committing to essentially, I'm gonna be in the banking business. I am going to commit every dollar that I can possibly muster up is going to go into policies, and I'm going to try to make that happen every single year. So in the entrepreneur stage, it becomes obvious that we are going to use the policy often. We're going to use the policy often in the entrepreneur stage. Why are we going to use the policy often? Because we don't have any money anywhere else. Understand this. If you have been asking the question, why would I use a policy to fund something, to fund an investment, to buy a car, to do whatever it is, when I have money elsewhere that could do it and I don't have to take a policy loan from it? I don't have to borrow money to do it. I've got the money to do it. Once again, that's because you are not in the entrepreneur stage yet. So it very well might not make sense to use the policy yet. You have it in the entrepreneur stage. A hallmark of this stage is that you are going to use policies quite often to fund every investment that you make, practically speaking, every investment. Now, I understand that life is way less simple than 4 stages, and I understand that. There's certainly overlap between all 4 of these. I'm just merely saying that these would be the easiest way to categorize things. So every investment you make is going to be funded from policy loans. Every purchase that's not going to be that's not just your regular monthly expense is likely going to be purchased from here. So obviously, I'm not saying every time you go to the grocery store, policies are going to be used in the entrepreneur stage. That's why we said every dollar of free cash flow is going to be used to fund policies. And because every dollar of free cash flow is going to policy, so in other words, we go back to our $1 million guy of income. and we compare him to the $100,000 guy that we talked about earlier, the $100,000 guy might be, 25,000 of premium might actually be might bring him to the entrepreneur stage for him. Whereas the $1 million guy, it actually might be more like $400,000 of premium is actually what is required to be in the entrepreneur stage. The biggest issue that you find is when you talk to the $1 million earner guy or whatever it is, and he thinks that he's committed to a high level of premium, and he's putting in 100, 200,000 of premium, and he's like, I've got big dollars going in. The problem is he still has $100,000, $200,000 elsewhere every year accumulating, and he's wondering why he doesn't use the policy all the time. Once again, because it's not that it doesn't make sense to use policies all the time, but the reality is if you don't set your life up accordingly, then it might not make sense to use policies all the time. And so the only way to break through and start using policies more often in a logical, rational manner, oftentimes is going to be to graduate from one stage to the other, which requires additional premium. So we're going to talk about that here in a moment too. So the entrepreneur stage is every dollar of free cash flow is going in. You're going to run it like a business. You think about it like a business. You're excited to pay premiums in this stage. You can't be afraid of premiums in this stage. We're going to talk about that. Once you got here, your fear of premium has got to be gone. And no one gets here without getting over that, by the way. So your fear of premium's got to be gone. That's the only way to get here. So you're using policies often. I mean, it's a common thing. You're going to use policies often in the entrepreneur stage as well. For every investment, every decent sized purchase, everything that's just not a recurring style expense. Lastly, by the way, and I wanted to mention this too. Your comfort level really should be determining what you end up doing inside of where you be at in this policy. I wanted to let everybody know that for a lot of people, the entrepreneur stage should be your ultimate stage. For almost everyone who's listening to this podcast, this webinar, I think that the entrepreneur stage likely should be your ultimate stage. This should be your goal. This is it. The lifestyle stage is the most complicated stage. And it is a stage that not everyone will even get to, nor should everyone get to. It's also going to be the most complicated for me to use as a hypothetical example, because in the lifestyle stage, not only are you moving not only are you doing the saver capital entrepreneur, in other words, you have every dollar of free cash flow going into policies. In the lifestyle stage, you start to redirect money that is going to be spent. Redirect money that's going to be spent, and this will be things like charitable giving or property taxes, income tax, property tax. In other words, what I'm saying is in this stage, in the lifestyle stage that you're in, not only is all of your free cash flow, all the money that you're able to save during the year and not spend going to policy premium, in this stage, you start to redirect money that's being spent elsewhere into policy premium, and then borrowing that money back out to fund whatever it is you're funding at the time, whether it's charitable giving, whether it's income taxes, whether it's monthly lifestyle expenses. Now, the reason that this one is really pretty difficult, and I'm having to look at my notes a little bit because it is the most difficult stage. The reason that it can be a lot of difficult is that it's the most complex to implement, and there has to be, and it's also as you enter this stage and this stage, stage 3 and 4, it's very important that you actually have a real advisor. Now, I know that is kind of salesy coming from an IBC advisor. I'm just merely saying that's the truth. You're going to want someone to hold your hand and lay things out on paper and illustrate exactly how it's going to pan out as best they can. You're going to want someone who knows what they're doing. That doesn't have to be me. I'm just saying you probably can't get to these stages on your own. I know it. You can't get it because you can't get over the mental humps, by the way. But all that to say, in this stage, you're redirecting money that's going to be spent, and you're purposely borrowing money each year to fund certain things. Obviously, for those of you who are listening, well, if every dollar of free cash flow is going into premium already that we possibly can muster up, and we're actually exceeding that with premium, which I have some clients doing. I'm not saying it's bad. I'm just saying you have to have a plan, because what is automatically going to happen is that you are going to generate what we call a strategic loan balance in this stage. In other words, you are going to be borrowing money from your policies in the lifestyle stage to fund things, and you are not going to be committing cash flow at the time to repay those loans in that moment. This is why it is the most complex stage. It is complex. It needs to be strategic. It needs to be strategic. It cannot be just willy-nilly either. So you want to know what your end game is. For those of us who have, or those of you who have been around for a while, you understand too. For those of you who've been around that we talk about how it can make sense to not repay loans if you have the money you could have sent to repay loans is going into premium for a period of time. So inside this, what we call the strategic loan balance is oftentimes meaning that we are going to we're going to pay premiums with money that normally we would pay income taxes with, or normally we would be doing charitable giving with. And we're going to borrow money out to do those things. And we are not planning to repay that loan right away. We're not committing cash flow. Instead, we are going to repay that loan sometime in the future, likely with some sort of windfall. I cannot give this justice right now. I'm going to have to do an entire webinar just on this and all the implications of this. This is a stage. This is a very personal stage. In other words, this is a stage that it is not everyone should commit to. And if you do commit to it, you just want to know what you're doing. It's not so the con of this stage is that you can do weird things in this stage that do not benefit you. By the way, this is why you need to have a coach. You need to understand the benefits you're receiving by doing XXX, and you have to lay it out. So in this stage, it's the most complex, it's the most strategic of all stages. It needs a plan. So these are the 4 stages: the saver, the capital builder, the entrepreneur, and the lifestyle stages. These are the 4 stages. I wanted to talk about a few things. I want to dive in to an actual real life example where we're showing what's going on in these people's stages. But inside of all 4 of these stages, essentially, many people, this is what I find, many people believe mentally, they are believers. They believe IBC works. They like the thought of stage 3 and 4, the entrepreneur stage and lifestyle stage. They think in their mind, this is what I want. This is extremely common. So many people believe mentally in stage 3 or 4, but they haven't committed to that level yet. This is extremely common. And so you will find people in the saver stage and in the capital builder stage. You will find people in these stages wanting to do the things that make sense in the entrepreneur stage and the lifestyle stage. They want to, pay income taxes. They want to do charitable giving. They want to make every investment from policies. They want to have everything they do funded through policies. They believe in this, but they have not committed to those stages. And so it makes things look weird. It makes them misunderstand what's going on. And so and it's crucial to understand that. One more thing to note while I'm talking about that is what sets your stage is not what you're doing with the policy. What puts you in one of these 4 stages is not what the transactions you are doing with the policy. What sets your stage is your premium level compared to your financial position. That is what sets your stage. What puts you in any of these 4 stages is not the transactions you're doing. It is your premium levels compared to your overall financial ability. That's what puts you in the stage. And then your premium levels should determine the types of transactions you are using the policy to do. So if you are not, and I'm going to go through that, by the way, so we're about to go and enter the next phase, and I think it'll make a lot more sense whenever I actually play this out with a real life scenario. But keep that in mind. What sets your stage is not what you're doing with it. Because you can do the entrepreneur stuff in the lifestyle stage. You can do 3 and 4, only having premiums of 1 and 2, but I'm telling you, it actually doesn't make any sense to do that. And by that, I mean, you're literally going to be borrowing money just to borrow money and paying interest to the life insurance company just to pay interest to life insurance company because you think that's what you're supposed to be doing. And yet you're going to have all this other money that's never even went into the system that should be into the system before it even makes sense to do those types of transactions. This is the case. So what sets your stage is your premium levels, not what you're doing with it. You can borrow money in the saver stage to make an investment, and that'd be great. However, if you're in the saver stage, it implies that you actually have enough money to make that investment from other resources, and you're just choosing to pull money out of the policy to do it. instead of using the other cash that you haven't even moved over yet. All that's going to end up doing is you're paying interest to the insurance company on a policy loan, so your bank account can be flush with cash. It would make more sense to take a policy loan out to fund that thing if you have committed to move that additional cash into policy premium. So what sets your stages of premium, not what you're doing with it, because you can do any transaction from any of these stages whenever you want to. It just may not make sense until you've committed to a higher level. One more thing to note. The only way, or what keeps people, and I'm moving on, and I've gone a long time, I know, what keeps people in stage 1 and stage 2, and even though they might be mentally thinking they'd like to try doing some of the transactions that make a lot more sense in the entrepreneur stage or the lifestyle stage, 3 and 4, but what keeps them in this side of the line over here, there's a wall that exists here, and what keeps them on this side is fear of premium. Fear of premium. That is what this wall represents. This line represents. What keeps people in stage 1 and 2 is fear of premium. Because it's premium that puts you in the stages. So in other words, they have the ability to pay more premium, but there's all these thoughts. Well, what if I can't actually commit to that? What if there's a year comes by where I don't have enough money to pay all the premium? There's a fear of premium. There is, what if I overcommit? What if I commit to too much premium? What if I lose my job? What if I do this? And so there is fears of premium. I'm just being honest. That is what keeps you. In other words, you may want to be practicing as in stage 3. You may believe in it. And you may believe in even in stage 4, and you really want to start unlocking the higher stages where a lot more things are happening in IBC for you. But what keeps you stuck over here in stage 1 and 2 is a fear of premium. And I don't have time to go into the reality of premium, by the way. I don't have time in this webinar. There is legitimate reasons to not overcommit to policies. There is legitimate reasons to not overcommit to policy premiums. Most of the time, people's fear of premium is based on misunderstandings of the flexibility, not based on reality. So I just wanted to, there's a wall in between it. Fear of premium is what keeps people from committing to and practicing IBC at the higher levels. I had it, Ray had it. That's why I said what you cannot be doing 3 and 4 and just be terrified of the premium. You also can't be nervous and weary about paying premiums. Like for me, the reason why I am in these stages right here is because I love to pay premiums. I've said it many times. It is not a marketing thing. It's not a sales thing. I've just like I said in the podcast, I've got a $40,000 premium coming due this month. I am elated to pay this premium. I can't wait because my cash value in that policy is going to grow by like $55,000, $60,000, something like that. I'm going to write a $40,000 check and I'm going to get $55,000 of cash value growth that year, whatever it is. And I'm excited. I can't wait for the day. It sounds so exciting to me. I love paying premiums. I know people think it's weird to say that. I know I've drank a lot of the Kool-Aid and I know I'm talking fast. That's because I've already gone 34 minutes. And I've got way more to do. But with all that being said, I'm saying that you have to, that's actually what you have to be. If you don't want to do that, then stay in stage 1 and stage 2 and do the transactions that make sense in stage 1 and stage 2. But don't be thinking in your brain that I should be doing stage 3 and stage 4 transactions whenever you're too afraid to actually get there. And a lot of times it's because of fear premium, many times it's based on misunderstanding. One last thing to note, just because you're in a stage right now, so in other words, you got started and you built up to be where you had every dollar of free cash flow committed to premium. And so you're in stage 3. Just because you were in one stage at one time does not mean you will always be there. In other words, and this has been the hallmark of my life, Nate Scott, talking to you, the hallmark of my life is I got started doing IBC 10 years ago. I'd always wanted to be in these 2 stages. I always wanted to be in stage 3 and stage 4. You know what was happening though, is I got started, I wasn't making any money, as is most of the time in a career, you're not making any money. So I started a small policy. And for the last 10 years, my income has steadily gone up. So what happens if I want to be in stage 3 or 4, but my income is going up too fast to where I no longer have every dollar of free cash flow going to premium? What do I have to do to stay in stage 3 and unlock all the transactions that make sense in stage 3? What do I have to do? I have to continually increase premium to match my free cash flow. And I have to do that every year. Why am I not afraid of premium? So many reasons. I'm just merely saying that's what you have to do. So just because you were in one stage does not mean you will always be there. It is a constantly adjustment thing. So the transactions that make sense in stage 3 and stage 4 assume that there's very little money of your income that's staying outside of policies, and you're then financing everything with policies. I hope that makes sense. Let's keep going, guys. I'm sorry. Let's keep going. So what I wanted to do on this next screen here is I wanted to actually go over a real life scenario. It's loosely based on me. It's loosely, by loosely I mean it's not any sort of real numbers, but I'm just saying what would my life look like if I hadn't been doing IBC as a young man for the last 10 years? And what happens if I was just to get started today with where I'm at? So I was like, let's build out a hypothetical guy loosely based on me, which means the income levels and the expense levels, they may be way higher than you listening. For some of you, they may be way lower. Just bear with me. It doesn't, everyone gets, the whole point is to understand the scales per se. So inside of this, there's a real life, I'm 30 years old right now. It means I got started at 20 years old. Can you believe it? How many of you on this call wish you had started when you were 20? I mean, I am blessed. I am blessed. So I'm 30 years old, and I'm going to go through someone who's similar to me. It's not obviously not exactly, but someone who's similar to me. What would each stage of commitment look like for them? And so I'm going to make some assumptions here. I have this guy, whoever this is, has an income of $500,000 gross income. That's how much money he earns. He's got monthly expenses, lifestyle expenses, things like that. We can call that lifestyle of $150,000 a year. He pays $150,000. I almost cut off that. He pays $150,000 a year in taxes, and he has $50,000 a year that he gives to charity. So this would just be kind of a rough idea. So $500,000 of income. He spends on his lifestyle $150,000. He pays taxes to wonderful Uncle Sam of $150,000. He has $50,000 he's going to give to charity, which means, by the way, that's 500 minus 150 minus 150 minus 150 is what's left. That's this savings and investment, and so he's got 150 left of his income, and the $150,000 is going to be saved. It's going to be invested somewhere. This is just his hypothetical situation, and so in this example, I was trying to think, okay, what would a normal person be doing? Not a Kool-Aid drink IBC guy who's got all of a whole bunch of money going into premium. What would a normal guy be doing? Well, if you talk to Dave Ramsey, Susie Orman, you talk to a lot of these other folks out there, financial gurus, like the ultimate goal for a lot of them is to have a 6-month emergency fund. That's what they all say you want to do. And so I was like, well, if I had $150,000 of monthly expenses to pay for my lifestyle, that means I'm going to need to have about $75,000 in cash for my lifestyle, for this pretend guy's lifestyle. That's what I would have to be doing. So I said, okay, I'm going to have, a 6-month emergency fund set aside. It's probably going to have 75 grand in it. And I'm currently also saving and investing in various places $150,000 a year. And so what I planned out is I'd say, well, I know I knowing me for sure, I'm a guy who does like to have some cash available. So I probably would over time be living on less than I make, and I would be slowly building up cash as well. So I'm going to assume that this person is going to continue to save about 10 grand a year into his cash warehouse, his cash storehouse at a bank. That's what he's going to do. So this little hypothetical scenario. Then he's also going to take $40,000 a year of his 150 of ability to save and so forth, and he's going to just set that aside for retirement. He's going to, put money in a 401k, an IRA, brokerage accounts, whatever it is. He's going to kind of set aside under the conventional world of retirement. And then, so that's 50 grand between his cash savings and his retirement program stuff. He still has $100,000 to work with, right? And so in my little hypothetical scenario, I'm going to say that he's going to take that 100,000 and he's going to make other investments with it. Maybe he's going to buy some real estate. Maybe he's going to invest in some alternative style investments. Maybe he's going to throw money in crypto. Maybe he's going to buy gold and silver. He can do so many things with that extra 100,000. And also I mentioned other investments or lifestyle. In other words, this would also be the money that for spending on things that's not the regular monthly expenses, not the lifestyle expenses, nor would it be money that he would technically need to per se take out of his emergency fund. So it'd be like maybe house remodels, maybe he'd pay cash for cars from this if he wanted to. Maybe he would finance cars and invest it instead. Who knows for sure, but it would be the 100,000 that's left is going to be invested and maybe spent on maybe a trip to Europe. I mean, there's just things that maybe he would be doing with his money depending on the year. So it's going to be saved or maybe spent on some bigger style projects. So this would be the guy's individual. So the question I wanted to get through today would be, well, what would each stage look like for this guy? What would each stage look like? Remember, by the way, it doesn't matter the numbers. It doesn't matter at all what the numbers are. You can divide by 2, you can multiply by 5. You know, if God has blessed you a lot, you can do whatever you want with these numbers. But this is just what would each stage look like? Remember, the stage is set by the premium level, not by the transactions that you're doing. The stage is set by the premiums you want to pay, and then the transactions that you're using the policy to do are based on what makes sense for someone who is committed to that stage. And the reason why is if you commit to a low level and you're borrowing money out to do things that you actually have money to do elsewhere, you're starting to be weird with it, and you're starting to think that there's some sort of magical property in policy loans. Instead, all you're doing is paying interest to the insurance company to have a large cash balance somewhere else. It doesn't make a lot of sense. So all that to say, what would this all look like? So we have the saver stage, the capital builder stage, the entrepreneur stage, and the lifestyle stage. And then I'm going to go through real examples, real policies of, what does this look like? So if we start on the saver stage, remember the saver stage of the policy, the saver stage is mainly a place to, store a little bit of money in. Your emergency fund is going to move over. There's no reason to have my $75,000 emergency fund in cash and to be saving 10 grand a year to the emergency fund. So the saver stage was that I'm going to move my emergency fund in, and I'm going to diversify. Instead of just storing up money in liquid cash in the bank in a savings account or a CD, I'm going to use the policy to do it. So in our little hypothetical scenario for this individual, what do you think is going to happen? Well, obviously he's going to start moving in his emergency fund money and his cash flow that used to just go to other liquid places. He's just saving some money. Instead of in a bank, he's going to save it into a policy. That's the saver stage for this guy. In the saver stage, that means that the $10,000 a year of premium of cash flow, he's going to move into premium. And this is going to be the complicated thing. So just listen to me really quick. He had $75,000 in an emergency fund, in his emergency fund, right? And we're going to move this $75,000 out of his emergency fund into premium for this guy. That's he's going to commit to the saver stage. He's just going to get started with something. And so what I did is I took 20 grand every year for 3 years. So I took 75 grand that he has in an emergency fund, and I pulled out 20 grand year 1, 20 grand year 2, 20 grand year 3 to slowly move the emergency fund in. And then the 4th year, I had $15,000 left, right? So I had 20, 20, 20, that's 60. And then year 4, I put in 15. After that, after year 4, all he's going to do is put in the 10, right? So he's going to put in 10 grand per year out of his cash flow, and he's going to move in his emergency fund, 20 grand per year for 3 years, and then 15 for 4 until it's all gone. And now he's got his saver stage money. This is what this would look like, by the way. This is what this would look like. So this is his policy. This is the 10 grand per year of cash flow, with 20 grand for years 1 through 3 coming from the emergency fund, and 15K in year 4 coming from the last bit that's left in the emergency fund. And you'll see that happening right here, don't you? This is the money that's moving in. So he's putting in 10 grand per year out of cash flow in year 1, and 20K from the emergency funds getting pulled out. And so this is what you'll see happening. So in years 1, 2, 3, and 4, he's moving out his existing cash savings, and he's putting in the amount of money that he wants to save into or he used to save, that he's going to save somewhere into some liquid safe place because he wants some liquid safe money. He's just going to transition it out. So this is what the bare minimum saver stage would look like. Now, the reason that I mentioned that this is kind of the objective stage, or this is the stage that everyone should really do, is because if I compare doing this to just doing what he was going to do anyway, and I just build a quick comparison, obviously it doesn't take a genius to understand that we're going to make a whole bunch more money inside of our policy over time than if we just left it inside of this emergency fund. So inside of his emergency fund, remember, he had $75,000 to start with, and he's going to add 10 grand per year into his liquid safe cash savings. So that means in year one, he would have had $75,000 in already, and then he would add 10 grand to it. And then right next to it, this is the actual balance that would exist if he was making 1.5% after tax. Now, for a $500,000 income individual, the tax rate's probably like close to 40%. So this would be, between state and local, this would probably be more like a, 2.75, 3% safe money storehouse somewhere. And then he would net after paying taxes on the interest income, 1.5% net after paying tax. So this is his scenario. Now, I just did a 35-year timeline until I'm going to be age 65. And I just stopped everyone there. And all I'm saying is, in our policy, we have $1.2 million, and in his emergency fund, if he didn't do the policy, he would have $589,000. So we're talking about $630,000 approximately of tax-free, no risk, additional profit, and $2.2 million of death benefit simply by, this is why I call it the objective stage. Like, come on, people. Don't do business with banks. They're not your friends. Don't leave money in those. We know this. And I know everyone on this call already believes this, but that's what I'm saying. I call this the objective stage. There's really just not, I don't know a reason not to do it. It's side money. It's just go ahead and get your feet wet in this stage if you want to, or something like that. So in this stage, I call it the objective stage because obviously there's no reason to store your liquid money up inside of this account. Now, if you remember though, I said this. Inside of this guy's life, this is just safe money that he's stored up, and he's going to do. All of us have some sort of measure of safe money that we kind of want to build up over time. In other words, this is money that there's no intentionality in this stage. He may end up using this policy. He may end up using this cash value, just like he may end up using the emergency fund for various things. But there is no intentionality involved. He is not saving up this money to accomplish anything in life per se, other than to continually build up and store up liquid, safe money available to him in case of emergency, or possibly an opportunity comes along. He's just going to want some money. Everything else that's going to be paid for is already accounted for. He's got $150,000 elsewhere every year that's being saved. Or I just accidentally did that. I'm gonna undo that. He's got $140,000 elsewhere in these two pieces over here to go take care of everything else. So it's rarely going to be used. And the same thing is true if you were to start this policy, and you will rarely use the policy. There will be rarely a time to use it, but you'll have people who think, well, I'm putting in 30 grand of premium. That's decent. The people, if you're making $500,000 a year and you're paying 30 grand of premium, you are not paying a lot of premium, folks. You are paying a tiny amount of premium. And if you think that it's kind of a decent amount of premium, that's because you think of the premium still as a payment. You're like, it's a pretty big payment. That's as much as I'm putting in my mortgage or whatever it is. And it's not a payment though. We're building a bank, of course. So I'm not going to go into that, but that's stage one. Stage two is along the same lines. And so in the capital builder stage, by the way, this is the most difficult stage to actually represent, because it is the fill up stage. It's essentially saying, well, stage one, the saver stage, is just merely safe place to store money. Stage three is every dollar of free cash flow going in. So stage two is obviously some level of commitment in between the two, right? This is some level of commitment in between the two. And it could be anywhere in between the two, but it's some level of commitment in between the two. So you have to kind of just roll the dice and see what it's like. What would a capital builder stage for this guy be? Well, if he's able to save a total of $150,000 a year, I essentially practically just cut that in half. And I just simply said, well, what if, maybe he's still going to fund his retirement programs, or maybe he's going to stop his retirement programs, but he's going to use that for policy premiums instead, because maybe he's got enough money in retirement, but maybe he's not going to commit to all of this. Essentially, he's just going to commit to some of the total. It's going to be a larger commitment than the saver. And we're going to probably include some intentionality in this stage, in stage two. In stage two, we're gonna commit to some sort of level of intentionality, where maybe he's like, I'm excited. I'm gonna save I have been saving money for my kids to go to school, and I'm going to put that into a policy premium. I have been setting money aside to remodel the house, or I've got some money set aside to remodel the house, and I'm going to use that for policy premium. I would like to, I normally pay cash for cars. I want to move that into policy premium so I can do it from a policy. Or what I mean is whatever it is for you. He's starting to build additional capital where we will start to use it more often. And when we started, it was likely we had some level of intentionality with it. So in this example, what I did is I assumed instead of just putting in his 10 grand per year of cash flow, he has 10 grand per year of cash flow going in the saver stage. We're going to do the same thing that with 10 grand per year in the capital builder, but we're also going to add 70 to it as well. So we're kind of cutting it down the middle. So in this stage, he's going to actually start a policy with $80,000 of premium per year out of his cash flow. Remember, his total cash flow, free cash flow, is $150,000. And so he's committing to he feels this is great. This is a big policy. On top of his cash flow, and every one of these scenarios, by the way, everyone assumes he's also encompassing the saver stage. So he's also going to move the 75 grand of emergency fund money that he has, just like he did in stage 1. He's also going to move that in the same exact way. 20K for years 1, 2, and 3, and 15K for year 4. The same exact way that he committed to last time. So this is what this would look like. This is what this would look like. Stage 2. He's got $80,000 a year of cash flow and 20K per year from his emergency fund that's slowly going to move in. So this is what this idea would look like. We'd have a total premium of once again 80 grand per year in cash flow and 20K per year 1 through 3 and 15K in year 4, right? Just real quick. So that's what you'll see happening right in here. So this is just by the way, this is just a rough draft. So in stage 2 for a guy in who's similar to me in my situation, $100,000 a year is to him, he's like, this is a pretty big policy. Now, what you'll find is that a lot of people are in stage 2. They've committed to stage 2. They're in stage 2, but in their mind, they believe in IBC as the stage 3 guy. This is where they get caught. What was the line down the middle? Fear of premium. Fear of premium. So in this stage, we have a guy who's committed pretty high level, but he's going to want to use the policy for all sorts of things. He thinks it's going to work out really well, but there is a fear still, and that's fine, folks. I'm not trying to be judgmental toward. I'm actually not. I'm just merely saying you're doing great. You're doing great here in stage 2. You're doing awesome, but you're going to be limited on what kind of transactions make sense to use the policy for, because there's still in this guy's stage 2 stage. We've got 80 grand per year going in, but how much was he saving? How much was his free cash flow on average? It was $150,000. So he's only putting in 80 grand per year out of cash flow. That means he still has 70 grand per year that he's not, that's going to build up elsewhere and be invested and purchased and expensed and all sorts of things elsewhere of his free cash flow that he's not going to incorporate in the policy, which means he can't use the policy to do everything. It's not like it wouldn't make sense to use the policy for some of those transactions, but he's created a situation where it doesn't make sense for him at the time. So that's exactly why the stage 2. By the way, you look at it, the other one was, obviously we're gonna have a lot of money. I wanted to notice by age 64 to 65, he pays an $80,000 premium and he gets back $442,000 of cash value growth that year. He's doing pretty good. The capital builder stage is looking pretty good for this 30-year-old guy who's doing pretty well for himself. Praise God. I love it. I'm just merely saying, obviously we're going to see much, the saver stage, he's doing pretty good too. The saver stage, he had what was it, 1.2 million of cash value. So yeah, he's 1.2 million there. We're at stage 2. He's at 7.5. This is a big stage for people. It's just not the ultimate IBC, like where we're using everything through it. What you find though is a ton of people who have committed to what they feel they're building a lot of capital here. And by the way, this is the complexity that I didn't add to it, by the way, and I mentioned this at the beginning. Obviously, we're going to be taking out policy loans from this. As time goes on. It's just built into the scenario that we're going to be making investments from it, that we're going to be doing different things. We're going to remodel houses. We're going to make down payments. We're going to do all sorts of things from the capital builder stage. We're just not going to do everything from it at that stage. And we commit to a very high level of premium considering, you're doing great. You're doing great. You just haven't committed to stage 3. So some transactions you're still not going to incorporate with policies. You're going to continue to do some things outside of policies, obviously. So stage 3 is the next stage. So in stage 3, the entrepreneur stage, remember the hallmark of this stage is that every dollar of free cash flow available to somebody is going into policy premiums first and then is being borrowed out. Maybe this person is, so once again, you go up to the top. If we're saving and investing $150,000 a year, what's his premium going to be? We already know. Now, I know life is not so cookie cuttery, but what I'm saying is we already know that he's going to be putting in about $150,000 a year of cash flow in the entrepreneur stage, which means that every time he makes an investment, maybe he's pulling money out to fund his 401k. Maybe he's pulling money out to fund his IRA. If he still wants those things, he's certainly pulling money out to do the house remodels. He's certainly pulling money out to send kids to school. He's certainly pulling money out for investments. In other words, in this stage, it becomes obvious what you're going to use your policy to do. In the third stage, it is the most obvious stage of what you're going to use the policy to do. Why is it obvious? Because you're going to be doing everything from policies out of necessity. This is why you have so many people like, should I do this with the policy? Should I do this? I've got this. And it gets all wonky. If you haven't committed to this stage, there'll always be a little bit of like, okay, should I use the policy for this, or should I just use that, or which one should I do which? Because you have means in multiple places. In this stage, the assumption is that over time, we've committed to a high level of premium that most things are going to be funded from policies. And it makes sense to do it from policies because that's where all the money is. So in this stage, we're going to put in $150,000 a year of cash flow. That is the entrepreneur stage. Every dollar of free cash flow, every dollar that's not being spent. And then we're going to add $20,000 per year, years 1, 2, and 3, and $15,000 in year 4. Remember, they ladder on top of each other, so forth. In other words, we're always assuming that emergency fund money that's sitting on the sidelines is probably going to move into. Now, even in the entrepreneur stage, he could sell some money out of his Roth IRA or some money out of a brokerage account and actually pay higher premiums if he doesn't want the money there. But this just assumes that all of the assets he's already built up, his brokerage accounts, his IRAs, everything, he's going to keep all the money in that to begin with, right? So we're just moving in the obvious emergency fund money that there's no reason to have sitting in a bank and give up $660,000 of cash over the next 35 years for fun. So we're going to move that into. So this is what this would look like. We have $150,000 of cash flow. That's all of his free cash flow is moving in. And then on top of that, he's got the $20K for years 1 through 3 and the $15K for year 4. Where is that coming from? The emergency fund, right? And you'll see that happening right here. $150,000 of cash flow going into premium, and then slowly moving the emergency fund. And then after that, just putting in $150,000 a year after that. This is the entrepreneur stage. Now, once again, as I brought up in the last one, I could have shown a whole bunch of random transactions. I could have just been pulling out policy loans to make investments, having the investment returns coming in, pulling out more loans for investment, making the investment returns coming in. I could be doing this, I can be doing that. And obviously, it would get extremely complex. Obviously, I don't even know if it's worth it because the point of this is to say that there's 4 stages of IBC. Obviously, there's going to be a lot of policy loans and a lot of investment returns and loan repayments being made for the various things. It's possible we would reduce premiums to make loan repayments if we needed to. There's so many things I'm not going to talk about today, and I know I'm going to get asked questions on. But bear with me. This was a simple thing. I'm helping you. I hope you're being helped to understand that there's 4 stages, different transactions make sense, different stages. Obviously, in this stage, we're going to have a lot of money. By age 65, he's got, $13.7 million. Look at the growth of this. He's putting in $150,000 of premium, and the growth is $813,000. He's doing pretty good as an entrepreneur. Now, obviously, there would have been a ton of loans out. There would have been investments made and all sorts of things. But this is the stage 3, the entrepreneur stage, is most people's ultimate stage. Most people's ultimate stage. It gets more complex the further we go out. So what are the cons to stage 3 and 4? Complexity rises. Commitment levels rise. Complexity rises. Coaching is necessary. Fear is behind you. If you ask me or you ask Ray, are you afraid to pay premiums? No. So if this was me, by the way, my premiums are more like $250,000 a year. So I'm as far as I can get and still climbing. So what I'm just merely saying is, yeah, I'm doing a lot for my policies, but I've created a situation where it makes sense. And here we are at the hour. I got to keep going. So the final stage is the lifestyle stage. The lifestyle stage means that we're obviously committing all of the free cash flow. We're in the entrepreneur stage, and we have decided, strategically speaking, with a plan, understanding the client relationship with me, and I have spoken to them, and we have had discussions, and we understand a lot of what's going on. We understand the assets he's bought in already that are invested elsewhere, and we understand a lot about each other. And we go to the lifestyle stage and we say, you know what, maybe I would like to build up a new policy to handle, in my example, I did the charitable giving. And so I said, I'm paying 50 grand a year to a charity already, into my church. I'm paying 50,000 in tithing already to that. What if I put that money into a policy first and then borrowed it out to give to that? What would that look like? Obviously, it would create a strategic loan balance, and I would have an idea for whether I'm going to write it out until the day I die, or if I'm going to use it as a place to store windfalls in the future, which is really what a strategic loan balance is. That will create a loan balance, but we'll probably fill up the loan balance because we have assets, we have a business, we have some things elsewhere that are likely going to be sold at some point and rolled back in. So that's very common. So it's going to create a strategic loan balance in stage 4, no matter what, or almost every time, stage 4. So in this case, we took the 150 grand of cash flow, but we added $50,000 to it, right? So our cash flow is actually 150,000 plus the charitable giving money. And of course, we're moving in the emergency fund. But in this scenario, we're going to have to borrow 50 grand per year. So it does get a little bit more complex in this situation. So what you'll see is the premiums are $200,000 a year for 4 years in this scenario. That's his cash flow that he's putting in. And why is it 220, 220, 220, 215? Why is it a little bit higher than his cash flow? The emergency fund. I was hoping I wouldn't have to keep repeating it over and over, but I'm sure I would get questions if I didn't. So he's also moving his emergency fund in every stage. In every stage, the cash that exists is moving in. It does, and so, but now he's committed to not only the 100. And by the way, it's likely he's going to have multiple policies in this mix. In other words, you're not going to start here. You're never going to start here, by the way. No matter who you are, do not start in stage 4. You grow up to stage 4. So you'd likely have to be adding another policy to enter that stage. So all that to say, though, the total premium is the only different for 4 years. And then what do? We actually stopped after that. So many reasons. I know I'm gonna get so many questions on this one, and I'm already out of time. I'm not gonna have time to answer everything. But essentially what we did is we didn't create a situation in a hypothetical example. You get to do whatever you want. In a hypothetical example, it's different than your example. So don't ask me questions about the hypothetical example. I made this up. I created it out. I pulled it out of a hat. I made it up. In your situation, you would receive your own. It actually look a lot like this, by the way. Some of our content look a lot like this with your own scenario going on. So in this case, we actually only borrowed for 4. We paid 4 years of premiums from the $50,000 charitable giving cash flow, and then we stopped putting the 50 in to borrow the 50. Put the 50 in to borrow 50. Then we could just go back to giving charitable giving out of our pocket, or we could choose to borrow and repay the loan each year. But essentially, the idea was we wanted to create a $200,000 loan balance in the policy. That's what we wanted to create. We wanted to create the $200,000 loan balance because we wanted a strategic loan balance. And in this guy's scenario, we would have known that we were creating it for a reason. And in this case, the reason was because he wanted to expand faster. He wanted to get more cash value going. And he had a strong understanding that as time went on, his income would go up and he may pay down the loan, or maybe he would sell an asset in the future because he had all of this money before he started banking, invested elsewhere, or maybe he's going to get an inheritance. And so at some point in time, he was planning on just paying off the strategic loan. I just put a line in the sand. I said, in year 10, we're just going to assume that that's when he paid off the policy loan at that time, using a windfall. And this is a topic all of itself. This is not the goal of this, but this was to show you what stage 4 would oftentimes look like for most people. And so in this stage, he's committed to a high level of premium. Actually, he's putting premiums in above his free cash flow. He's borrowing money to give to charity, which he was going to have to do anyway. He has to. borrow money out to give to charity because he doesn't have the charitable giving money anymore. So of course he's gonna be borrowing out to do it. We did that for 4 years to capitalize this. We've created our strategic loan balance. We're gonna assume he repays it in 10 years. We also assume to keep it easy that he contributed the outlay column right here, by the way, the outlay column. He's paying interest on the policy loans. Where do we get that money? I don't know. Nor do I care. This is an example. The point, I get so surprised, by the way. I do these types of things and everyone asks the detailed analytical questions like, where did the money to pay the interest go? I don't know. Let it accrue. Who cares? All I'm saying is it's a lot easier just to show it if we're paying interest out of pocket, so we can just have nice, round, easy numbers instead of compounded interest and all the changes that would require. But all that to say, it was 5% interest. The reason why his premium was 150, but he's actually contributing 160 for these years and 157, and it's just simply that's the interest on these policy loans that he's just paying out of pocket, just so we can keep the loan balance nice and easy to understand, and everyone on the example can understand what's going on. And so at the end of this time frame, all he did was change one thing from the entrepreneur stage, and he's gone to $14.5 million of cash value. The growth of the policy at this stage is almost $850,000 at this stage. It's a little bit better than stage 3. At that time, it was, it was 813,000 of growth versus 850,000 of growth that year. So we've set ourselves up a little bit better just on that one little transaction. All right, everyone, we've made it. We've made it. All 4 stages laid out with a real example. I know it was simplified. I know each stage was simplified, but I'm just merely saying this is the best I could do in an understandable way, was to understand that there are 4 stages of IBC. There are 4 real stages. The saver stage, where you're just saving money and it's kind of moving into your emergency fund, and money that would have just stored up kind of liquid anyway, maybe some diversifying going on where you want some safe money as well. That's going on in the saver stage. Rarely will ever use it in the saver stage. Rarely will use it. There's no intentionality. We don't intend to use it. It's not like we're planning in our mind, like we're going to do IBC to do X and X. We may use it later on, but it's not something that we're going to intentionally do. And it's kind of the objective stage. It's a stage that everyone should do. There's really no reason to let that money accumulate in a bank. It's never going to be better. It never is going to be better. The capital builder stage is like the next jump up. It's now we have added intentionality to it oftentimes in the capital builder stage. So that's the big difference. The hallmark is that we have intentionality. We're putting in money that we are pretty sure we're going to use because we want to accomplish things with the policy, and we're directing cash flow into premium to do that. We're going to use policy a lot of times, especially for personal reasons. There's a lot of intentionality. We'll do a lot of things with it in this stage. The entrepreneur stage just takes that to the extreme, and that says we're going to do almost everything from policies because we have devoted every dollar of free cash flow to pay premiums. In other words, it's not like I'm just going to use my policy for everything. I have to use my policy for everything in the entrepreneur stage. It makes sense to use my policy for everything because I have situated my life in such a way that now it makes sense to do everything. The lifestyle stage goes one step beyond that, where it's not just your free cash flow paying premiums, it's redirecting money that's actually already going to be spent to premiums, which means you're going to be borrowing money out to do those things. And you're going to create, by doing that, a loan balance that you don't have an intention to repay right away or a cash flow to devote to it right away. And so oftentimes we call it a strategic loan balance because we understand that it's likely some sort of windfall will occur, maybe your income is volatile and some years are great years and some years are down years. So you would like to have a strategic loan balance. So in the good years, you can just dump money into the strategic loan balance and pay down the loan anytime you want and have that flexibility without creating a mech or anything of the sort. So it's more complex, it's more strategic. What keeps people in stage 1 and 2 is a wall that we always refer to as fear of premium. It's obvious, and oftentimes it's built. It is true that there may be a reason to be afraid of premium for certain people. There is a chance to extend yourself and possibly we understand that. I'm just saying, but almost everyone doesn't go. Their mind actually, most people's minds believe at least in stage 3, sometimes even in stage 4, like that's what they want. But because of the fear of premium, they never go there, and they're trying to do entrepreneur transactions and a capital builder or even saver stages, and it just doesn't work. It's just no reason to try, or you can, but the only net effect is that you're going to pay policy loan interest for fun without the corresponding benefit of additional cash value being created. So this has been really fun, guys. I hope you enjoyed it. It's what oftentimes one more thing to note is just because this guy's in these certain stages during one point doesn't mean he's going to stay there either. So it's why do I keep adding new policies to the mix? It's because my income keeps going up and I want to be able to do IBC like an entrepreneur. I want to be able to be at least in the entrepreneur stage, if not in the lifestyle stage. It's my desire. And so I have to constantly be increasing premiums just to keep pace with my income. It's very common. I hope you guys have had a great time. I've really enjoyed giving it. I've got a lot more to do. We've gone an hour. I want to now open it up. If you'd like some questions, I'd be happy to answer them really quick. So there is a question and answer box. If you have any questions, you can ask them now. And if we don't have any, then I must have done a great job. So I got Wes. I like this differentiation. This helps a lot and is a great way to see where you are and what your goal should be as long as you're self-aware. Yeah, absolutely. That's actually the whole point of this. The whole point is to make you self-aware. What have you actually committed to? And then if you don't want to go to the next stage, then just do the transactions that make sense in your stage. Or commit to the next stage so you can do way more transactions to get more benefit from it. But you can't do the transactions of the next stage in a lower stage and expect to have some sort of miraculous results. It doesn't work that way. Your premium levels put you in a stage, not your desire to do certain transactions. So if you have committed to a premium level like he did, maybe he's saving 150 free cash flow that goes, and it's not just savings, it's free cash flow. It's money that's not being spent recurringly. 150,000 of not money. Now he may spend it on the house remodel, on the vacation. He may do some things out of the ordinary with that, but it's not money that's being spent recurringly. And so if he's putting in 80 grand because he's afraid to do 150, that's fine. It's just you can't do everything that you could have done with the policies, or it wouldn't make sense to do everything you could have done with the policies at the 150 stage of commitment. That's when it makes a lot of sense. How many years does it typically take to go from a saver or capital stage to an entrepreneur stage? Yeah, that's a great question. It can be as soon or as long as you want, Adam. It can be as soon or as long as you want. So whenever you definitely don't want to commit to the lifestyle stage day one. No one ever does that. It doesn't even make sense. Don't overwhelm yourself. Some people do we have plenty of clients who have actually started the entrepreneur stage. The biggest issue that I find is we have people who think they're in the entrepreneur stage and who are not. They have not committed. They think by their dollar amount of premium they've committed there, but they haven't. They haven't committed there yet. And so they're trying to do IBC as if they were in the entrepreneur stage, but the premium level is too low. And so it starts getting weird. It gets weird because they always have cash everywhere else to do everything that they're doing. So it does get weird. Do you get a card, like a debit card, credit card, so you can get away from the banks? No, I mean, in all of these examples, it assumes you're still paying your monthly expenses, the vast majority of them through the regular checking out bank account style scenarios. So it's not really like we're pitching this as get rid of your checking and savings accounts per se. So you don't get a debit card or credit card, so you can get away from the banks necessarily. You're still going to need a bank account. You can open up a life insurance line of credit from a bank and have functionality like a bank, to where you could, borrow money. You can actually write checks and do things. Sometimes you even get a debit card attached to the credit line, but it would still be kind of through a bank. The insurance companies don't have that type of functionality. All right, everyone. I think I'm going to shut it down. If you have any specific questions that I didn't get answered, you guys are welcome to send them to me. My email is nate@livingwealth.com. I'll write it out here, nate@livingwealth.com. You are welcome to email me with questions anytime. I'll try to answer them as best I can. nate@livingwealth.com. But guys, it's been really fun. It's been really fun. I've really enjoyed doing this. I think I'm on to something. I hope it was helpful. I'll be sharing more about this type of stuff, maybe with even more detail in later dates, but I think this is a good start. So I do, I am excited. So, by the way, one more thing to note after I got a question here, you don't have to start in stage 1 and then grow to stage 2 and then grow to stage 3 and then grow to stage 4. You can start in stage 3. You can start in stage 2. You can start anywhere you want. It's not like you have to go from one stage to the other, by the way. Just one final thought. You don't have to go from one stage to another. You can start. You can even start. We have people start as an entrepreneur stage. We really do. They're so committed right away. They love this stuff. Now, you would rarely ever get started in the lifestyle stage. That normally doesn't make sense. But certainly anywhere along the time horizon. All right, guys. Thanks so much. If I didn't answer your questions, you can shoot me an email if you want. But thank you guys so much. Have a great day.